Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. You can click on the link below. Now, I've drawn a number of lines here. The first one is the primary downtrend line. Of course, we have a spike out of this line, which is the rally to 37.5 that occurred when we first broke up on the MACD. I don't have the MACD on here. But you can see we rallied up there and then we got a big smackdown. But that's the only real penetration of this line. That's why I've drawn it the way it is. You can see now that we have a correction through time that has gone outside of this line. So it's not a breakout, but it's just a sideways consolidation that takes us out of this downtrend. The question is, are we going to see a breakout to the upside from this trend? Now, I think we will. The other thing to note is that we have a downtrend line of the volume here. Now, a lot of people have questioned the NetDania volume. There's other volumes that I could use, but clearly we have a downtrend in volume and a flat top here. What does this all mean? Well, first of all, it means that this set of lines here that I've drawn is a consolidation area. Now, one could look at it as being bearish in that it is consolidating at a lower and lower price. You can see that we had a spike down into the area and we got right back out. Another spike down and we got right back out. Then another falling off, selling down. We didn't get out, and now we're just kind of consolidating near the middle of the bottom of this area. And that would seem to be bearish, except for the fact that when you recognize that the trades have consolidated in this area, that means many people have bought and sold, and the base is actually growing stronger here. Now, could we turn down and go lower and break out of the lower channel? Yes, we could. But my guess is that they pretty much exhausted the ability to sell it lower than this. The bottom of this line is roughly 26.5. You're going to see more and more physical buyers come in as the price gets cheaper, even though you're not seeing the volume of buyers come in on the paper price. So in my opinion, it's actually bullish to see the volume decline and the price stabilize. That's the sort of thing that you see before you see a big move up. So it's still an incredible deal to have this suppressed price and be able to stack physical silver. I don't believe that the relationship that we have currently between the physical price and the paper price is going to hold up much longer. At some point, the paper price may continue lower, but the physical price will cease falling, or the paper price is going to turn up and the physical price is going to go even higher. But I think we're approaching that point in time that the disconnect occurs between the physical and the paper market. So we'll just have to wait and see on that. Now, there's an article that just posted from Hedge, and the reason I'm covering it is it's so fascinating. I'm going to read it and then I'm going to take you to the video. This is Tyler Durden's "Behold the Fed's Takeover of the Bond Market." The must-see time-lapse video below, courtesy of Stone McCarthy, shows the distribution across the entire curve of the U.S. marketable debt as it was held by either the Fed or the private sector over the past 3 unconventional monetary policy programs, starting in 2003 and concluding yesterday. In one short minute, this clip demonstrates very vividly how the Fed effectively took over the U.S. bond market. Some things to note. The reason why the Fed no longer holds any debt with a maturity under 3 years is because ZIRP through late 2014 language, which means there is no point for the Fed to hold that debt. For all intents and purposes, it is the equivalent of cash. Debt maturing between now and 2014 amounts to just under $5 trillion, which means the Fed only has about $5.5 trillion in marketable debt with a maturity over 3 years to work with, and already owns about a third of it. It also means that as all the Fed's holdings in the under 3-year category are sold, Twist will have to be extended, and with it ZIRP language to beyond 3 years, most likely 5 years or so. What is very visible is how the Fed had no choice but to expand its SOMA limit holdings per CUSIP from 35% to 70% soon. Once the Fed owns 70% of every longer dated CUSIP, it will have no choice but to again extend the maximum permanent holdings, this time to 100%, as it gradually becomes the entire market. If after watching this clip anyone still believes that the biggest bond market in the world resembles anything even close to a fair and efficient, or which would have clearing prices anywhere near to where they transact now, they may want to double down on the Facebook IPO allocation now. Initial marketable debt distribution by holders starting back in 2003 when the Fed's first monetary policy started. That's this chart, and the most recent, that's that chart. So let's take you over to the video here and let's run it. This is a time lapse photography. Before I start on it, I want to explain to you what you're looking at here. The stalactites, which are essentially these black lines that are hanging down, that's the Fed. The stalagmites, which are these light blue columns poking up, that's private ownership of treasuries. So what this is going to show you is how, as the financial crisis accelerates, that the Fed begins to take on more and more of the debt. The other thing you're going to want to watch for is how the Fed takes over the long-dated end and the private market rushes towards the short dates. That's going to be rushing towards cash. So let's go ahead and play that so you can see it occur. So you can see the date right here is scrolling past, and you can see that the Fed jumped into the short end here, but you're going to watch as the financial crisis occurs, the private market rush towards this short end and the Fed rush towards the long end. So we're about to the crisis here. We're at 2007, and as we get to 2008, here you go. You can see the blue accelerating on this side, the black will accelerate on this side. That means that nobody wants long-term treasuries, everybody wants short-term treasuries. What does that mean? That just simply means that in bonds, the two risks that you have are always going to be inflation risks and default risks. You got to remember that a bond represents someone loaning money to somebody. So the risk they take when they loan money is that either they will be paid back in dollars that are worth less than what they loaned, or they won't be paid back at all. So as the private investors begin to doubt the safety of paper assets, they begin to rush towards short-dated treasuries, and they flee from long-dated treasuries. Of course, the Fed's going to fill in the slack here on the long end, and the private is going to rush towards the short end. So we're going to see that happen now as we continue into the financial crisis. Now you can see the stalactites are expanding. The Fed is taking everything here on the mid to long end, and then as we get later in this, you can see it's exploding now. The Fed is taking, this is large scale asset purchases. This is QE2 coming on. The Fed is taking more than half of the long date, and the private or sector investors are rushing towards the short end, and we'll continue. And that's about where we are today. So you can see the Fed is now up to 70% on the medium long term, and they're a large percentage of most of the long term. Let's try to get a shot of the last of it here. And that's about the latest we can get. So you can see that it's now completely switched. Everybody in the private market is rushing towards very short-dated maturities here. You can see 1 year is the 1.4, but these are the treasury bills, etc. So the majority of the private market is clustered over here in the short dated, basically cash, while the Fed is the only one who is willing to take the risk to take these long dated maturity bonds. And of course, why? Because no one's willing to take the risk that either the Fed's going to print a bunch of money to pay them off and it'll be worthless, or they're just going to simply default. So a fascinating analysis of what is going on, and it's very clear that the Fed is buying up all the debt, and we're in the process of monetizing the debt. The U.S. is bankrupt, and now it's just a matter of the facts coming out. So I wanted to take you over to the other main story of the night, and we're going to start with the chart. This is a chart of Zynga, and as you know, I've been following a lot of these, what I will term scam stocks, and we're in what I will call .com 2, where we have these companies unloading the shares of their experimental and probably, in my guesstimate, ultimately worthless endeavors. You can see here Zynga, which IPO'd back in December of last year. So this isn't a really old thing here. It's relatively new. It's not even a year old. So you can see it IPO'd at around 9. Had a brief rally. Then, of course, all the Wall Street buyers came in. The pumpers came in. And then we had that spike top, and then just a relentless decline. Now, if you remember, I've covered Groupon recently. Groupon went below $5 today. $5 is a very key point. You can see that Zynga absolutely collapsed at that $5 level and never recovered. So we now have a $3 stock. So let's take a closer look at Zynga, because I think it's going to be very enlightening. So the first thing we want to watch is the Zynga video, and let's find this here. This is a video of Mark Pincus. He is the CEO of Zynga, and this is a video of him talking about how he launched the whole operation. And it's from TechCrunch.
I knew I wanted to control my destiny, so I knew I needed revenues right fucking now. Like, I needed the revenues now. So I funded the company myself, but I did every horrible thing in the book to just get revenues right away. I mean, we gave our users poker chips if they downloaded the Zwicky toolbar, which was like, I don't know, I downloaded it once, I couldn't get rid of it. So we did anything possible to just get revenues so that we could grow and be a real business, because it's a different story. If you walk into Corey's office and you've got a real business that's profitable, you know, he's asking you for your card, you know, he's like, wait, don't leave yet, you know. And, oh, you're not looking for money? We're offering money. So control your destiny. That was a big lesson. So by the time we raised money, we were profitable, and that made a big difference. So, I mean, I control my company today. I created a B stock with 10x the votes, and I control the board and the stock, and I got investors who I was already friends with. So there's a lot of things that can help you be more successful down the road, you know, that you can do if you got it all right. And
so there's Mark Pincus talking about how he launched Zynga, and that comes from this article from Tom Goldman on Escapist magazine. I'll go ahead and link that. But let's take a closer look at Mr. Pincus and Zynga. As you can see, the stock's about $3. It doesn't even really have any life here. But let's look at the financials of Zynga. It's still a $2.28 billion company, and you can see that if we go to the key statistics, on Yahoo. You can see that there's a float of 522 million shares. There's actually 759 million shares outstanding of this company. Very interestingly, we have a short percentage float ratio of 20%. So that's very interesting right there. A fifth of the float is short. It looks like those people bet correctly. But now let's take a look at the insider trades, and this is for Mark Pincus. You can see that on April 3rd of 2012, Mr. Pincus unloaded 16.5 million shares of this stock. So the proceeds of that sale was $192 million. $192 million is roughly 10% of the current market cap of this company. Now, you'll note here it was on the 3rd of April 2012 that these shares were unloaded. And also, you want to look up here and note that currently Mr. Pincus only holds, yes, 0 shares. So it appears that Mr. Pincus followed the same morale that he had in his video there, that he was willing to do whatever it took to make money. And we can see here that now he owns 0 shares, but he's walked away with $192 million. Now, again, let's go back to our chart of Zynga, and you can see that it was April 3rd that he unloaded his shares. And you can see here, this is the daily chart. So each one of these lines is daily. And you can see that on that date of April 3rd, you have roughly about a little bit more than the 16 million shares. That's pretty much the entire number of shares that traded that day. And you can see here that we had a breakdown below support, and then we had a little bit of rally, and then as the people come in here, then it just sells off, and an enormous crash in the value of this stock. So again, we have to ask the question, well, if Mr. Zynga, Mark Pincus, is selling his shares of Zynga, then of course we want to know who's buying them. And we can take a look at the major holders of Zynga stock. And by the way, this is closely related to Facebook, which just dove below 20 today. And then, of course, Groupon. I was going to cover LinkedIn. I'll have to cover that in a later one. But that one's still very high, so people might want to look at that. But you can see here your investors, of course, T. Rowe Price. That's a mutual fund, your 401ks. Janus here. We've got Capital Research Global Investors. We've got Morgan Stanley. Of course, Morgan Stanley has their fingers in every crooked pie that you can have here. And here's Morgan Stanley Growth Cap. Here's T. Rowe Price. Here's Janus. So again, Fidelity's in there. Of course, you always have Fidelity involved. So again, we have this guy who pretty much on his video admits that he's into scamming people. He's into getting people to download some toolbar that even he can't remove, so he can pump up his revenues, so he can create an IPO, he can dump it off on the public, and of course he now has 0 shares, and apparently feels so guilty that he's established Zynga.org so he can give back and be a philanthropist. Kind of reminds you of some people like Bill Gates, etc. So same pattern, same thing they always do. And what is so amazing is that people have any confidence in these people after they've done the same thing over and over and over and over again, and yet the public keeps buying into these scams. So again, the only safe investment that you have in these days of scams and frauds and crooks and liars and thieves is to invest in a real asset that is no one else's debt obligation. that is no one else's projected fantasy of future earnings, which evaporate into a online game that really doesn't make anybody any money and goes the way of the dot-com craze. So that's going to be silver and gold. Of course, my opinion is that silver is much more likely to be a dramatic rising investment once the floodgates are opened, when people begin to flood in there. As I covered yesterday, the powers that be are doing everything they can to discourage people from flooding into these investments, and of course they're going to fail, just as the London gold pool failed. The silver price, physical price suppressors are going to fail. Very soon we're going to see a disconnect between the physical and the paper price, and then of course the physical price is going to explode, and ultimately it won't be available. Then you're going to see currency crises, and you're going to see governments collapse, and then you're going to get a reset, and we'll get the new system. But until then, you want to keep stacking at these incredibly rigged low prices so that you're able to come out on the other side of this thing in some semblance of wholeness. And we'll talk to you next time.